Hey everyone, welcome back to Paisa Pathshala. You've probably seen them, those high-energy Instagram reels or YouTube videos promising you can double your money in a week with one secret stock. It's tempting, right? But today, we need to talk about the reality of financial advice on social media. The first big myth is that there's a get-rich-quick scheme. Influencers often show off luxury cars or expensive watches, implying they bought them with a single lucky trade. In reality, most of that wealth comes from selling courses or brand deals, not from day trading in the market. Let's talk about hot tips. You might hear, buy this penny stock, it's going to the moon. In the stock market, a penny stock is a company with a very low share price, usually under 10 rupees. These are extremely volatile and often lack stable business models. Following a random tip is not investing, it's just gambling. Another common trap is the over-diversification lie. Some influencers tell you to hold 50 different stocks just to stay safe. But if you hold too many companies you don't understand, you aren't diversified, you're just diluting your returns. It's better to own a few good businesses or a low-cost index fund. Ever heard them say, just follow what the big players are doing? They might show you a screen of FIIs, foreign institutional investors, buying a stock. But by the time you see that data, the big institutions have already made their move. Retail investors like us are usually the last to get the news. Then there's the analysis trap. An influencer might draw a few squiggly lines on a chart and call it technical analysis. While patterns exist, they aren't a crystal ball. They don't predict the future, they only show what happened in the past. Always look at the company's actual business, not just the lines. A major red flag is when someone pushes a specific stock without mentioning the risks. Real investing is about balancing risk and reward. If an influencer only talks about the upside, they are leaving out the most important part of the conversation: what happens if the company loses money? Many influencers also ignore the importance of an emergency fund. Before you put a single rupee into the stock market, you need 6 months of expenses in a liquid savings account or a liquid fund. If the market crashes and you need money for rent, you shouldn't be forced to sell your investments at a loss. Don't fall for the screenshot proof. It's incredibly easy to use photo editing software to make a portfolio look like it's worth crores. Unless someone is showing you audited statements, which they won't, take those gains screenshots with a huge grain of salt. Remember the concept of survivorship bias. You only see the influencers who got lucky once and kept talking about it. You don't see the thousands of people who lost their entire savings following that same advice because they don't have a platform to post their losses. So, how should you actually learn? Start with books, ACBI-registered websites, or official educational resources. If an influencer sounds more like a cheerleader than a teacher, it's time to hit the unfollow button and look for someone who explains the why behind the what. Your actionable takeaway for today is simple: stop chasing tips. Instead, set up a monthly SIP, systematic investment plan, in a reliable index fund. It takes away the guesswork, reduces the risk of market timing, and builds wealth patiently over years, which is the only proven way for most of us to win.